Gap ups, gap downs, and earnings reports. This is one of the more advanced sections of the course here. So the first thing I want to go over is what is a gap down. So here's a gap down here. You see the stock, let's say, was trading around 295 or so, Ulta at the close here. You wake up the next morning and all of a sudden it's at 270. It opens at 270, goes up a little bit, and then before you know it's down even further. So here's the gap down. It closes here. The next morning it's here. That's a gap down. Here's a gap up. Stock closes around, let's say, $311. Next morning it opens at, let's say, 327 or so, and then it goes up here and then it closes here. So that's a gap up. Stock closes here, gaps up to here, and then closes the day here. So here you see there's a gap in the chart. Here is a gap down. The stock closes at this point here, and it gaps down and opens over here. So that's a gap. Gap down, gap up. There are times when a stock will set up. It will form a base and a pattern, and it will break out. But it's not going to break out on a normal way. It's going to gap above the buy point. So for instance, let's say you wanted to buy a stock at 100. Now the stock's at 120. That's a gap up, right? Overnight it gapped up 20%. So you're not just going to buy any gap up. It's got to be a gap up from a proper base. If stock gaps up above your buy point, you're going to place your stop loss where you normally would and then enter the current price and the stop price in the Excel. If the Excel percent is double what it would normally have been, I usually just let the stock go and look to buy the stock on a pullback or another entry point. So let's say I wanted to buy a stock at 100, and overnight the stock gaps up and now it's at 101. The gap is from the close at 100 and now it's at actually let's put in this example. You wanted to buy it at 100 and yesterday it closed at 99. This morning it opens at 101. It gaps up from 99 to 101 above the buy point. Okay, so that gap, it's not that huge of a gap. It's just a little over 1%. I'm talking about if the thing gaps up like 20%. That's when we have to play different rules in. So let's say I wanted to buy a stock at 100 and I was going to put my stop loss at 95. The stop gaps up to 110. Now if I'm going to buy at 110 with the stop loss at 95, that's a very wide stop. So in that instance, I'm going to have to re-examine the plan a little bit. Some traders, what they like to do is they like to buy the stock when on the gap up and use the stop loss 3% below the low of the gap day. For me personally, I don't like to buy a stock on the day it gaps up. I'm going to wait another day or maybe even wait a few weeks for a pullback. So we're going to go through some examples how I play a gap up. So here's a Lululemon here. Here was the stock. Closed here, let's say around 148 or so, and the next morning it gaps up huge. Something like this, I'm not going to buy it on this day because it's such a large gap up. It's too difficult to put your stop down here. I'm going to give it some time. Either look for a pullback or I'm going to buy it at another entry point. So that's a gap up where the gap up day, I'm going to give it some extra time and I'm not going to buy it on this day. When you see something like this gap up like this, you could try a few different things. The first thing you could do is you say, well, I'll put my stop loss at the 50-day like it's mentioned in the course. But you see this is a really, really large stop loss. So that may be a little bit too much. Another thing you can do is you could try to put your stop loss below the low of the gap up day, which let's say this is the low is 552. You could put your stop loss at like 540 or so. You could try to do something like that. Or you could try to put your stop loss somewhere down here. That's one thing you could do. Or you could just say, I'm going to let it go and look for a pullback. Gaps are tricky. Usually something like this, I would just let it go and say I can't be in everything. Now, here's what I want to show you here is what happens with gaps sometime. This stock, Lululemon here, it gapped up from, let's say it closed around 171. In the morning, it opened at 181.99. So it gapped up, okay? And then throughout the day, it went down, 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 and it closed at 173.25. So you see that was this black candle here. It had the gap up to 180, and then it closed down around 173.25. So what we do in a trade like this is if you see a stock gapping up, I don't like to do trades early on in the day. This is why I wait till 3 p.m. Because you see at this point here it was above 180. It looked like it was going to gap out. It was going to break out. Came back down. So we're going to wait until 3 p.m. before we do any buys. This next part of the course in this section, we're going to talk about how to do a buy if a stock breaks out. The most important thing I want to mention is you're not just buying any time a stock gaps up. It's got to be a gap up out of a proper base. I very rarely am buying these gap ups like this. Most of the time a stock gaps up, I'm looking for a pullback. The next examples I'm going to show you are going to be advanced ones. And they only work if it's a true leading stock and a true innovator in its sector. Okay? And it also has to have a good chart pattern. So let's look at an example. Facebook in 2013. Facebook was special in 2013. It was a recent IPO. You're going to see in the next chart. It gaps up 29%, which is very rare to see a stock gap up that much in a stock as large as Facebook. Smaller stocks can do that, but stocks as large as Facebook usually don't gap up 29%. Facebook had been a recent IPO. It hadn't really gone on a big run yet. It was been consolidating for months, was building a big, huge base. So that made me curious about buying the gap up here. And I want to really hammer this home. I don't just buy any gap up. It's got to be a gap up out of a huge base and a breakout that really is coming out of a proper pattern, and the stock's got to be early in stage 2. Stock must also be a game changer and an innovator. Facebook, in my opinion, was the definition of a game changer because it totally changed the way we interact with people and communicate with people. Let's take a look. So you see here, Facebook gaps up 29.61%, which is insane. Smaller stocks can gap up like this, but you very rarely see a stock that as big as Facebook gap up like this. You very rarely see. Look at how many shares were traded. 365 million shares. Wow, that's really amazing. Whoa, I couldn't believe that. So you see, this is a really strong move to see that many shares traded and for the stock to move this high in one day. And you see it gaps up here. So I didn't buy it on this day. Let's take a look what happens next. Here's the weekly chart here, and you see here's the IPO. Now a lot of people got burned here. They bought Facebook IPO here. They're buying it on this day here in May of 2012, and they're buying it at 44, and then it goes down. And then a lot of people here, they lost a lot of money. They're selling it in here. And then people who use charts, they're saying, okay, this is a big cup and a big handle here. Nice low volume in here, no big selling, even lower volume in here. And you see the massive volume here as it breaks out here. And here's a cup, a little bit of a handle, boom. Now, here's how I buy it. Here's how I play a situation like this. The stock gapped up, and here is the gap up day. Some people, what they would do is they would buy it on this day, and then they put a sell stop around 32. I like to give it another day. So I gave it another day, and I said I'm going to buy as soon as the high of the gap up day is taken out. So you see this day here, this is July 29th, 2013. Facebook now closes above the high of the breakout gap up day, and I'm going to put my stop around 32.75, which is right around the low of the gap up day. You could even use it a little lower if you want to give more leeway. So I can't put my stop at the 50 day because it's way down here. So I put my stop a little bit low below the low of the gap up day. Now, at this slide, I want to show you Facebook's an absolute monster here. You see we buy it on this, then it goes up and up and up and up. And you can see it's not even approaching its 50-day moving average yet. Amazing, just amazing strength. Most people look at this gap here and they say, wow, that thing's extended. But it actually can be a sign of strength. Here's the breakout. We buy it on this day here when it clears the high of the gap up day. And just a nice strong movement up. And you see it doesn't even approach the 50-day moving average. Now, shorter term traders, you're going to sell here around maybe $50 or so when it closes below the 50-day. If you're somebody who wants to give Facebook a little bit more room, you're going to sell on a close below the 100-day. And look at that. It bounces right off the 100-day. This is why I used the 100-day. I noticed stuff like this was happening a lot. So it bounces right off the 100-day, and it gets you in the move higher. If you sold it here, if you're a 50-day trader, you got to look to get back in somewhere. If you wait for a close below the 100-day, you get to stay in for this move. So you see Facebook, it looked extended down here, but it's just going up and up and up and up. It's funny. We buy it around, let's say 35.43. You can see here it's almost double. It's crazy. Stocks can do crazy things like that. So this is why we review the past, so we're ready to make big money when we find ourselves in this situation again. Finally, you get to close down here at 56.95 and you sell. But you do give up some of your games here, but this was still a great move, a great trade. You buy it here, and it holds it here, and then you sell it here, and a nice winner in Facebook. Here are some lessons we learned. To most people, Facebook seemed like a good buy on its IPO date, which was right back all the way over here, right? They think this was a good buy. But we don't buy on the IPO day. It's too dangerous. We have to wait for the stock to set up properly. Facebook seems extended at the 29% gap up, but we view this as a sign of strength because we saw it was a good base and it was an innovative company. We're buying it around 35 and selling us at 58. It gives us a nice profit. We're going to buy when the high of the gap up day is taken out. And I usually wait for a close above the high of the gap up day. And you place your stop loss below the low of the gap up day. This is a rare type of buy. I'm not going to just do this on any stock, but you could see Facebook was an especially strong stock coming out of a base. It had been a recent IPO. And most times when a stock gaps up 29%, it's extended. But this time, it was a great buying opportunity. So I want you to make sure you realize that most times I'm not buying a stock if it's up 29% on a gap up. This was a rare opportunity. It was a true IPO. It was a true innovator, I should say, a recent IPO, and it was coming out of a long base. Let's look at Tesla here. Tesla here has a 15% gap up on huge volume here. So this, I'm not going to buy this stock this day. I'm going to give it some time. Too extended for me. I'm going to give it some time. Here's the weekly chart here. Here's a big cup and here's a big candle. You could buy it on this day and then you probably get stopped out around here. It's part of trading. I don't forget about a stock because I get stopped out. I keep it on my watch list. Now when it gaps up, it's a little too extended. So this is why I don't buy on the gap up day. You get stuff like this over the next coming days sometimes. So I'm going to wait. I'm going to wait for the high of the gap up day to be taken out. Now here's what you could do. You could do one or two things. The first thing you could do is you could say, I'm going to buy when the high of the gap up day is taken out. I did a little bit of a cheat buy on this one, and I bought it when the high of this day was taken out. The reason why I did that is this was a very long candle. I really like Tesla, and I wanted to get in a little bit early, so I bought on this day. And what I like with Tesla, see the massive gap up, not really much selling. So I felt that was the sign of strength here. Stop loss is around 40 here, below the low, the gap up. I'm sorry, stop loss is around 40 here. The low of the gap up day was here, but I want to use this low because he pulled back a little bit. So I put my stop around 40, which is right here, the low of the pullback here. You see Tesla here. Even if you waited a little bit longer and you waited for this high to be taken out, you see you buying here on this day when the high gets taken out. Tesla goes on a monster run. That buy is around, let's say, 47, and it doesn't close at all below the 50-day. Look at this. Run. I mean, this is over triple. This is insane, right? I mean, this is a triple so far, and it hasn't even closed once below the 50-day. Finally, a close below the 50-day. So you can, if you're somebody who wants to get out on a close below the 50-day, you could sell there. If you want to give it a little more room, you can wait for a close below the 100-day, and then you sell here. So this was a huge monster trade. Let's look at some lessons we learned from it. This is an extremely rare gap up that I would buy. Tesla was a true innovative company coming out of a large base. It really was innovating cars, electric cars, and making them popular. And Elon Musk was becoming an icon. The gap up of 15% on massive volume. And remember, we don't buy up on the gap up day. We're going to wait a few days to see what happens. We had the cheat buy on this day because of the long upper shadow on the gap up. And I didn't place my stop loss on the low of the gap up day. There was a pullback afterwards, as you could see. You see the pullback here. So I placed my stop under here because it pulled back a little bit. This is why I don't like to buy in the gap up day. I feel sometimes there's some action like this where it pulls back and you don't want to get knocked out. People who buy on this day and put their stop down here, they get knocked out. So that's why we give it a little extra time. And this buy shows the power of holding a big winner above its rising 10-week or 50-day moving average. You could see here really this insane move, and it doesn't even really approach it at all other than this one day here. Just an amazing sign of strength. The stock seemed extended at 47, but it stops at 190. It seems like, it can't really get higher than this, right? Well, it really can. So you never know what a stock can do. Let's look at Google here. Google here, you could buy it on this day and put your stop loss around here. That could work. when it takes out the high, the day here, it was a close one here. That's why I picked this day. So you could buy it here and put your stop down here, or what you could do is you could buy it on this day and put your stop down here. Either one could work. And we want to close above the high of the gap up there. This one might have been just a little bit short, but if you got in a little earlier, it still works. And this is the day I would do because it's a clear close, and then you have the stop loss down here. And what I like here is there's really no selling and the big volume coming in. Here's the weekly chart. You can see Google down here. Nice little base here coming out of its recent IPO here in August. And you see we're buying it in here. If you sell below the 50-day, you sell here. 100-day is not breached, and you see it heads higher again. So you have to pick what type of trader you are. If you're a shorter-term trader, you're going to sell on a close below the 50-day here. If you're somebody who wants a longer-term trade, you're going to wait for the 100-day to be breached, and you see it boom, 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 boom. It really starts heading higher even again. Finally, the 100-day is lost, and you sell around 192. Now we bought it at 113.20, and you're selling at 192. So that's a nice gain, and you can see the massive volume here. It's really starting to turn over here. So we got to get out before our gains are lost. Lesson: Google was a recent IPO, totally revolutionized how we search for information. Everybody uses Google, even the term Google it, right? So it really was a game changer. Seemed extended as it gapped up above 100, but it was just a starting move. We don't buy on the gap up day. We're going to wait for a close above the high of the gap up day. We place our stop loss below the low of the gap up day in this instance. And Google does not lose its 100-day moving average for approximately 8 months. And that 100-day moving average, it keeps us in the trade. Let's take a look at Apple now from 2014. So here's a daily chart in May 5th, 2014. And you see it gaps up here. Next day takes it out. Next day, a huge day higher. Then a very orderly consolidation here. So there's a few different days you could buy it. On the gap up day here, we're not going to buy it here. Now on the next day here, if you buy it on the next day here, it just clears barely. It just barely clears this area here. So there's a few things you could do. First thing you could do is you could buy this day here, you put your stop down here. Okay? If you want to be a little bit more aggressive, you put your stop 72.50 or so. So if you want to be very aggressive, you buy it on this day, you put your stop down here 72.50, which is very aggressive. It would work out in this trade, but it's very aggressive. Or what you could do is you could put your stop down here if you want to be more conservative. The next day, this day, it heads higher again, and a very big day higher. Then it consolidates very, very orderly here. Very quietly and orderly on very low volume. Now you see all these big, huge gray volume bars. It shows that Apple's really being accumulated. So you have one of three options that you could buy. You could have bought it on this day here, and you either put your stop around here, 72.50, or way down here if you want to be more conservative. You could have bought it this day as well, and then you probably put your stop here around 72.50. Or you could buy it on this day here, which is May 5th, 2014, and you put your stop loss around 73, right around here. So you use a wide stop loss around 73, and you buy in here. This is almost like a flag type pattern here. Big, huge move up, quiet early consolidation, and then a nice continuation here. So we use a wide stop to give it room just in case it needs to pull back to the 50-day moving average. In the weekly chart here, you see a big, huge cup and handle. Here's the big cup. I like it so round like a U, rounded like a U. Here's the handle here, and I like the way the handle goes downwards here. See, it goes downwards here, shakes people's out. Other than this 1 week, which it has the huge down volume, other than that, it's pretty orderly. I like how it's nice and low volume here. Once in a while, you get 1 week like this. You let it go if it's 1 week. If you see many weeks like this, if you would see something like this in the handle, you got to pass on the stock, okay? It's okay if it's on the left side if it's like this, but if you see this big, huge red volume over here on the right side in the handle, you're going to avoid the stock, too much selling. So we let this 1 week go. Other than that, it's pretty calm and orderly, and then boom, big move higher here. When you see a big cup and handle, it has the potential for a big move. So you see, here's the gap up here. Here was the first day we could have bought it. Here was the second day, and here's the third day down here. So you see Apple heads higher, and what I like is you see the 50-day moving average here. It bounces up here, doesn't even touch it down here in this reaction. On this day here, comes down, comes right back up. So we don't sell intraday moves below the 50-day moving average. We wait for a close. So you're still in the trade. On this day, the 50 days lost. So if you're somebody who says, I want to sell on a close below the 50-day moving average, you're buying it somewhere down in here, and then you're selling it in here. It's a nice profit. You notice it bounces right off the 100-day moving average. This is something that happened to me many times in the past, and it convinced me to keep using the 100-day moving average to keep me in trades longer. So it bounces right off the 100-day moving average and heads higher again. If you sold it here, you could try to buy it again back in here. Maybe, I guess, on this day, you could buy it back. But I'm somebody I like to stay in the trade longer. You see the 100-day holds. 100-day moving average still holding down here. Loses the 50-day. Boom. Heads up higher again. 100-day moving average, 2 bounces higher. And here's where things get tricky. Closes below the 100-day moving average. Here it found support at the 100-day. Here it closes below. A rule is a rule. You got to sell here, okay? Because you don't know that this is going to happen. This is part of trading. This is why I'm showing you this. Sometimes it works. It's like here it works, right? If 100-day holds, it heads higher. Here it closes below. A rule is a rule. You have to follow the plan. You sell here, and then it heads higher without you. You can try to get back in, maybe over here. But sometimes this happens when you're trading. No system is perfect. But either way, you're selling here, let's say around 98 or so. And the buy price was, let's say 78. So still a nice gain. Still a very nice gain. And like I said, just because you sold here doesn't mean you can't try to get back in here when it breaks out again. It's part of trading. No system's perfect. Let's look at Baidu here. Baidu here, huge gap up. And what I like here is no selling here. So this is why we don't buy on the gap up day, because you see sometimes they pull back. It's a little hard to handle. So we give it some time to wait. No selling as it consolidates. And then we have to wait for it to close above the high of the breakout day. So this day here, we're not going to buy on this day because see it goes up, comes right back down. So if you wait until 3 p.m., it keeps you out of the trade. And then Baidu's an absolute monster here. You see it closes on May 21st, 2007. It closes above the high of the gap up day this day. So this would be the day to buy it. And the volume is up on that day. So it's a good trade to take. And now I put my stop around $12. You put your stop down here. It's a wide stop, but you got to be conservative just in case it needs time to pull back. And look at how far it is from the 50-day moving average. So I put my stop around $12. Now, this is a big, huge cup and handle here from the IPO. So it's not a perfect pattern. I would like this more to be down here, more U-shaped. It's not a perfect pattern, a little bit sloppy, but still somewhat of a cup and a handle here. Not the best, but forming somewhat of a cup and handle. What I like here is the very low volume here, and then the big volume coming here on the right side as it heads higher. And you see here it's starting to head higher. This is a weekly chart still. Now we're in September 2007. And now we look at the daily chart here. We buy it here. And if you're somebody who sells below the 50-day moving average, you're going to sell it here and you get a small profit. But it bounces right off the 100-day. So if you're somebody who's a shorter term trader, you're going to sell it here on a close below the 50-day. Make a very small profit. I shouldn't say very small. You make a profit, and then you're going to buy it back here when it breaks out again. If you're somebody who's a longer term trader, you're going to wait for a close below the 100-day. You see it comes down to it. It bounces right up. Never goes below the 100-day. It keeps you in the trade, and now it heads higher here. So you see Baidu here, we're buying it around 1347. If you use the 100-day, it's up to 3075 when we get to November. That's why I like that 100-day moving average. If it's a very special stock, that's why I like to use the 100-day moving average, because it holds in many instances. It's not perfect, but a lot of times it holds. And if it's a stock that, is not my favorite or something that I'm not really so fond of, I'll sell on a close below the 50-day, or I'll sell at 3R or something like that. But if it's a special stock, recent IPO, a stock that I think it has a lot of potential, real innovative company, I'm going to give it some little more room to run, and I give it some chance to stay above the 100-day, as Baidu does here. Now you see here was the bounce from the previous slide. I'll just show you just in case. That's this candle right here. Here it bounces, it starts heading higher here. You see it closes below the 50-day here, but still above the 100-day. Keeps us in the trade a little bit longer, but eventually we've got to sell. And you sell on this day here around 32. So you get a nice gain in Baidu here, and this is January 2008. So that 100-day keeps you in the trade for a long period of time. Some people would say, well, you should have sold at 42. It's very difficult. It's very difficult to know the exact top. It's very easy after the trade to say, oh, you should have sold at 42. Very difficult when you're in the trade. That's why I like moving average. They're clear cut. When you use the 100-day moving average as a trailing stop, you're never going to be out exactly at the top, but it keeps you in a lot of the gains. So you see Baidu here looked like it was way extended right back here, right? It looks like it's way extended at 1347. Before you know it, it's running up to 42, and it really goes on a nice run. So these stocks can really move, and sometimes those gap ups, especially if it's an IPO and it's breaking out of a big base, they can really run higher. Lessons from Baidu: it seemed too high after the gap up, but it doubles from the buy point. Second thing to take from it, the 100-day moving average held throughout most of the run higher, and it kept us in the trade. Priceline example. Huge gap up. Now here, Priceline here, I'm not going to buy a gap up like this. Some people, what they'll do is they'll buy something like this, and then they put their stop at, let's say, 26 or 25. I like to give it a few days wait. Here's the weekly chart. Just a complete monster. Boom. Chart's a little sloppy, but still, this is very impressive. Nice low volume here, big volume here. Big volume here, low volume consolidation in the handle, and then boom, massive volume as it heads higher. So here's what you could do. We had the gap up day. We had the next day here. Now, when the high of the gap up day is taken out and there's a close above it, we can buy it here. We put a stop loss at 26. Let's see what happens with Priceline. Oh, comes right down, and we get stopped out. So first we buy it, consolidates a little bit. We have a wide stop here. Goes up a little bit, comes down, we get stopped out. Okay, after we get stopped out, it starts heading higher again. Stuff like this happens. No system is perfect. I don't know what to tell you. You're never going to find something that's 100% perfect. So you just learn to deal with it. You say it's part of trading. You stick to the plan. You stick to the system. You don't take it personally. You don't completely change the system. You say that's just part of trading. Now, here's what happens with Priceline here. It goes up, gap up. We buy it this day. We come down and get stopped out. Then it gaps up again, right? And as you see, it's very volatile, very difficult to handle. If you wanted to, you could try to buy it on this day here as it breaks out again, I should say. You put your stop at 30, 31. Huge volume here as it makes a new high. The weekly chart is very sloppy. Honestly, this is something I probably wouldn't buy. I didn't buy it back here in 2006, but this is something that's very sloppy. I probably would pass on it. A big important clue, though, is you see the NASDAQ is still trying to find its way. NASDAQ's still off a new high, where Priceline is at a new high. So that's a good sign of strength. That's an important clue that it could be a leader. And you see it's a big, huge move, and it's a monster stock, and it heads higher from that buy point. This is a stock I probably wouldn't buy it on this day because it was so sloppy, the chart. But it shows that there's no trade that always, I should put it this way, there's no way you're going to be in every trade. There's no way. Sometimes you have a stock and it's on your watch list, you get stopped out, it heads higher. It's part of trading. A lot of people have a fear of missing out. They feel like they have to be in every trade. You got to get over that because there is no way you can be in every stock. And this is an instance where this stock was very difficult to handle, and you see it heads higher, and we had some entry points that here we tried and it didn't work out. It's part of trading. It's part of trading. What's interesting, I like to see when this one here is the 100-day holds the entire time. So you see, even through all these shakeouts, 100 days holding and holding and holding, it keeps you in the trade. There's a few dips below the 50-day, but the 100-day heads higher and keeps you in the trade. So lessons, no system is perfect. Sometimes you get stopped out, the stock heads higher without you, there's nothing you can do. And some stocks are very difficult to handle. As you can see with Priceline and Booking, very difficult to handle. This is part of trading. Don't take it personally. It's just that's the way it is. The important clue to see from the chart was Booking or Priceline was at a new high while the NASDAQ was still trying to find its way and many percentage off a new high. So that was a sign that Booking could become a big-time leader. And the big lesson from this example is can't be in every chart. You can't be in every stock, I should say. Sometimes a stock is difficult to handle. It's just part of trading. Gap downs. Okay, so gap downs are the ugly cousin of gap ups. And if you've been trading for a while, you found yourself in a situation where you're in a stock and it's going to be gapping down. not a fun situation. So we're going to go through this in the course. So now you see what to do if you're in this situation in the future, because you will be in this situation again. So here's a gap down. Stock's around, let's say, 98 or so, and you wake up the next morning, and it's at, let's say, $90, has a little bit of a rally intraday, and then it heads down during the day and closes at 85. So here's the gap down. It's over here at 4 o'clock. You wake up the next day, it's down here around 90 at the open. So that's the gap up. All of a sudden, down here, that's the gap down. There's a gap in the chart. Tesla, you can see here, this was a gap down. It was right around, let's say, 290 or so. And then it gaps down here, all the way down to here overnight, and it closes up here. So that's the clear candles with the red. That means it gaps down, and then it goes up a little bit. So it's still a down day, but it rose a little during the day. So a large volume gap down could be a sign of weakness. You see here this big, huge gap down here on the big volume. Some people think, oh, that's a sign of a bottom. Sometimes it could be, but a lot of times it's a sign of weakness. And in this case, it's a sign of weakness, and it heads much, much lower. And here's another gap down on big volume, and you see that Tesla just keeps going down and down and down. So gap downs are not fun, and you don't want to get a situation where you're in a major loss and you're still holding the stock. That is not a good idea to do. This was Twitter. We showed this in the IPO course section. Everything's looking great. Oh, down 24% in one day. Stuff like that happens. It's part of trading. So here was a big gap down here. Rose a little bit intraday and then fell down even further. Huge volume, part of trading. See Dick's Sporting Goods. We're on here around 48. Gap down here. A little bit of a rally here. And then down closes at 39.75. So what should you do if your stock gaps down? Well, let's put it this way. Let's say your stop was, let's say you buy a stock at 100 and your stop is at 95. The stock's at 103 and it gaps down to 90. Okay, you got to get out. Get out. Some people say, well, I'll wait for it to come back. No. Get out. Because you don't want to be in a situation where you're wanting to risk no more than $300 and now you're losing $800, $900, $1,000, $2,000. You never want to get in that situation. So you're in a stock and your initial stop is, let's say, 95, and the stock gaps down to, let's say, 90, get out. Take your loss and get out and move on. Let's say you wanted to wait for a close below the 100-day moving average and the stock gaps down. You're going to wait for the close and then you get out and sell the stock. Now, if it's a situation where it's gapping down way below the moving average, you can try to get out earlier if you want. But most of the time, it will be somewhat near the moving average and you wait for a close. But the whole key I want you to get is that you cut your losses and you get out. Even if it's below the initial area you thought you were going to sell out, you got to sell at a gap down because the stock could head way lower. Let's look at Crocs. This is an example of a stock that really gaps up here. So here you see it. This is almost a 20% gap up here. Huge move on a massive volume. Okay, wow, look at that. Woo! And I like the calm consolidation here and the massive volume as it heads higher. So here's the gap up day. And then this day, it goes up intraday. But remember, we want to close above the high of the gap up day. So you could buy on this day. And if you miss that day, it consolidates quietly here. You could buy it on this day. And you put your stop around 32, which is down here. Okay, let's see what happens with Crocs. Okay, so it heads higher. We're buying it down here. It heads higher. The red line is the 20-day moving average. So you see 20-day holds sometimes, but not always. 50-day holds except for this day. Here, it closes below the 50-day. So if you're a 50-day trader, you buy it in here and you sell it in here. You get a nice little profit. The 100-day holds keep us in the trade longer. If you sell on a close below the 50-day here, you got to try to buy it back here on one of these 2 days here as it breaks out again. 100-day holds the entire time, keeps you in the trade. You're buying it here, you're still in the trade here. Now, here's where things get nasty. Crocs gaps down 36%. If you sell on a close below 100-day, you're selling it here. You still get a profit because you bought it here and you're selling it here. But you see a lot of your profits being evaporated in one day. This is one of the worst gap downs I've ever seen. I specifically went back to the stock charts in 2007 to find this example because I had heard about this one. This is one of the more notorious ones. I've seen stocks gap down 25%. That's the most I've ever seen in personally watching a stock, 25%. Most times you're going to see a stock that gap down, no more than 10 to 15%. Okay, this one was 36%. Now I used to trade very volatile stocks when I was younger, and I would experience 20 to 25%, which is killers, right? I've never seen anything 36, and most of the stocks that you're going to deal with are going to be between 10 and 15% most of the time. But this is an extreme example, and a large part of the gains are wiped out, and you still get a profit. If you bought it here, you still make profits on the trades. It's just a very frustrating trade. But this is part of trading. Here are the lessons. Anything can happen. Stock gapped up, and it can gap down, right? Volatility works both ways. What's interesting is when Crocs gapped up, that was just the beginning of the move, right? And then everything looks great, right? Everything looks great up here, and then out of nowhere, it gaps down hard. So it's part of trading. Don't give up on a system because of one bad trade, and you have to hold on to winners to make big money. So when you're holding big winners, sometimes you're going to experience a trade like Crocs with the gap down. It's part of trading. But you can't give up on your system. You got to keep your winners, and you got to cut your losses. That's the key to trading. Cut your losses, hold your winners. If trading was easy, everyone would be rich. You have to be mentally tough. You have to come back from a trade like this. You come back, you say, it happened, whatever. I'm going to forget about it. I'm not going to let it anger me and frustrate me anymore. It's gone. I move on to my next trade. Gaps and earnings reports. A lot of times a stock will gap down or gap up if an earning report is coming up. So the earnings reports are going to be announced when the market is closed. Okay, either pre-market it's going to be announced or post-market. So maybe it's going to be released at 4 o'clock or 4:30 or maybe 8 o'clock or 8:30. It's going to be released when the market is closed. And whatever happens with the news, there's a likelihood the stock may gap up or gap down the next day. So let's say I buy a stock and earnings are coming up. I'm going to buy less shares because I want to make sure I don't have too many shares that put myself at a lot of risk if it would gap down a tremendous amount. If I'm at a loss at a stock and it's about to head into earnings, I will sell most or probably all of my shares. So let's say I bought a stock at $100 and now it's at $97. I'm going to sell all my shares if earnings are coming out, are going to be released in the end of the day. Because if that stock was to gap down, I would sustain a massive loss because I'm already at a loss, right? And I don't want the thing gapping down way below my stop loss point. So if you're at a loss and earnings are coming up, get rid of the position. Now let's look at an example of Lulu here. And Lulu is an example of a stock that gaps up after earnings. So here's a Lulu prior. See, it's setting up, nice cup and a little bit of handle here, and then a little bit of a flat base or a box on top of the cup and handle here, right? Looks great. Earnings are about to be released. Now, when I was young and stupid, what I would do is I'd say, I'm going to plow into this thing and I'm going to make a load of money, right? I did this once with Green Mountain Coffee Roasters, and I plowed into it right before earnings, and I made a huge amount of money in this one trade. And I said, I'm so smart. I buy those stocks before their earnings when they have those patterns, and I plow into them, and I made like $4,000 in like 1 hour. Well, the flip side of that is you do that a bunch of times and it heads the other way and gaps down. You learn you're not so smart. So you learn to respect risk. So if you see a stock setting up like this, you don't buy it prior to earnings. You got to wait for it to gap up or gap down or break out, right? And you can't just assume everything's going to work out great. So here's what happens. It sets up. Here's the black candle when earnings have been released. It gaps up, and then it closes down at 75. So a black candle means that for the day it was up. It was up for the day here. It closed the other day here, and then it closes here. But it was up intraday. It opened here and came down here and closed here. So still up for the day, but there was a lot of selling in that day. And notice it closes below the breakout area. So you don't buy it. You don't buy it on that day, but you keep it on your watch list. And because we wait till 4 p.m., we don't buy it here. I used to buy stocks at 10 o'clock in the morning or 9:30, and I would buy it here, and then before I knew it, it'd be down here. So this is why we wait till 3 o'clock, and then before you know it, a few days later, it closes right here, and you buy it on this day when it breaks out again here. You buy it here, you put your stop down here. And nice volume on all those days. So here's the weekly chart now. You see here is a cup and a handle, broke out, flat little base here, now it breaks out and emerges. And this is from June 17th, 2019. And here was the day where it gapped up. If we bought it at 9:30, we would have bought it here, and then we would have been at a loss that day. We wait a few days later, we buy it here, we put our stop down here, and it starts heading higher. So what's the lesson? There's no need to rush. Okay, you see a stock setting up. You don't say, hey, you know what? I know this thing is going to be a big winner, and it's going to go up 30%, and I'm going to plow into it prior to earnings. You don't do that. You got to wait for the chart to give you the signal to buy it. And when you wait till 3 p.m., it keeps you out of moves where a stock gaps up way higher in the morning and then heads down intraday. So that's why we're going to wait till 3 p.m. to buy a stock. And keep stocks on your watch list. You see with Lulu here, maybe on the day it gapped up, it wasn't buyable. We keep it on a watch list. A few days later, we're able to enter. Now we're going to talk about a gap down, which is not fun. And I want to reiterate, you have to know when the earnings report is going to be released, right? So if I know a stock's earnings report is going to be released, I know that there's a chance it could gap down 15% or even 20%. And we saw in the Crocs example, it was even worse. So the way you're going to handle this is you're going to solve the problem before it even comes up. The way you solve the problem is you reduce your position, your size, before you enter the earnings report. So let's say you had a stock and you normally buy 100 shares. Right, using the Excel, it says you're going to buy 100 shares. If I say, well, earnings are coming out tomorrow, maybe I'll only buy 50 shares. That's the first thing I could do. Now, if I'm at a loss, if I had been in this stock for a few weeks and now I'm at a loss, I'm going to sell all my shares prior to earnings because I don't want to have the risk that the thing gaps down. And now, if I have a nice cushion, then I can hold my stock through the earnings report. So let's say I bought a stock at 100, stock's at 110. I have a cushion now, so I'll hold it over earnings as long as the market is strong. And as long as the other stocks in the sector are strong. If there's an instance where every stock in the market is gapping down, there's massive selling, it's conditions like 2008, I'm not going to hold the stock over earnings. But if it's a nice general trend, if stocks for the most part are acting pretty well around earnings, if I'm in a cushion with this stock, and then I will hold it over earnings. So first thing you're going to do is you're going to go to Yahoo Finance, and you're going to type in the name of the stock. In this case, it was Microsoft, and you're going to look for the date that the earnings is going to come up. And they're pretty good. They're going to tell you different dates that the stock is going to have its earnings, and that way you're prepared and you jot that down on your calendar. As we said earlier, stocks can gap down 15 to maybe 10 to 15% on most stocks that you're going to have. I've seen as much as 20 to 25% gap downs. Not fun at all. So you got to think about how much money are you going to lose if the stock was to gap down. Think about the worst case scenario, and then you adjust your position accordingly, okay? If you're at a loss prior to earnings, I highly suggest you sell all or most of your shares. You don't want to have a situation where you're already at a loss, and then it gaps down 15 to 20%. Now you're at a massive loss. If you're around break even, I would say you could sell half. That way you feel like you have a nice position, but it's not terribly risky. If you're at a profit, that's an instance where you could hold through the earnings report as long as the general market and the stock sector is strong. If every stock in the market or sector is gapping down on earnings reports, you get to conservative and sell your position. Smaller, lesser known stocks are more likely to gap down 20 to 30%. But there's still a large risk of gap down with larger stocks. So we're going to see Netflix coming up, right? You see Netflix gaps down, I think it's like 15%. Most of these stocks like Apple, Facebook, Netflix, you're going to see between 10 to 15 most of the time, sometimes up to 20%. I think Facebook a few months back had a 20% gap down. So most of the stocks that you know of Facebook, Apple, that have a larger market cap, most of the time it's going to be 10 to 15% at the worst, upwards of 20%. When you start getting to these smaller stocks, you could see crazy things like a 40% gap down. So as I said, using a wider initial stop and buying less shares reduces some of the risk, because if the stock gaps down, let's say 20%, you have less shares, so you'll have less loss. So it's all about managing risk. Let's look at the Netflix gap down from July 2019. So here's Netflix before earnings, okay? It's at 362.44. And I go after hours here, and this is 9:12 in the morning the next day. So this is July 17th, okay? And then on July 17th, at 4 p.m. they released their earnings reports, and I knew it was going to be down, a gap down, so I made sure I captured this for the course. And you see, I go on my broker here. This is Interactive Brokers, and it's at 9:12 in the pre-market on the next day, July 18th, 2019, and I see Netflix is set to open 10% lower. So Netflix was here yesterday, and then on this day, it's all the way down here at 323.40 here. So you see, this is going to be the gap down. So I know it's going to gap down 10.77%. So here's at 9:30 a.m. Netflix gaps down. It's all the way here. It's down 10%. It's 10% gap down, okay? And then you see by 9:31, there's a slight rally. And this is due to the uptick rule. So the uptick rule triggers. Uptick rule basically, what they're trying to do is give you a chance to get out if you own the stock and let those people sell the stock. And there's going to be no shorting, I could say, during that period. So uptick rule means you got to wait for an uptick before you short the stock. 9:35 a.m. You see it. There's been a little bit of a rally here. Gap down here. The open was at 323 here, and then it's risen to the last at 327. So there's at 9:35. There's been a little bit of a rally, and then by 9:49 the rally has faded again. And then you see at the end of the day, Netflix has had a very volatile day. So what's the lessons here? Let's say you were in Netflix. Okay, first thing you have to do is you have to know when the earnings report is coming up. That's the first thing to do. Second thing, if you had a loss prior to earnings, what you're going to do is you're going to sell all your shares. If you had break even, you can sell half your shares. If you had a cushion, what you're going to do is you're going to say, well, how's the sector doing? How's the general market doing? If you had a cushion and the market's good, sector's good, you're going to hold through. If you feel that matches your risk tolerance. So when you look at the pre-market and you see it's going to gap down, you're going to have to get out of the position if this is something that you're in and it's much more of a loss than you were intended. So let's say I was intending to sell Netflix at $355, let's say, $355. This is not a trade that really we would take, but I'm just using that as an example. Let's say you bought Netflix on this day here. You bought it here, and now you really wanted to sell it here, and it's going to gap down. What would I do? Here's what I would do. I usually try to get out on a gap down between 9:35 and 10 a.m. The reason why I'm saying 9:35 is stocks are very volatile for between 9:30 and 9:35, especially if the earnings were announced. I used to sell exactly at 9:30 and I get the low of the day. So usually what used to happen to me when I first started out is I would sell right away here at 323, and then the uptick rule would get triggered, and then all of a sudden we're at 327. So an advanced rule, or advanced strategy I should say, would be to try to get out between 9:35 and 10 a.m. Now this is very advanced. If it's too advanced for you, just sell it at 9:30, okay? But what I do is I try to get out between 9:35 and 10 a.m. And what I do is I set it up with my broker and I put in an order. If I know the stock's going to gap down, I'll put in the order to trigger at 9:35. Okay, and the reason why I'm doing this is sometimes the stock gaps down, the orders gets filled, and there's a slight rally, and I could get out. Doesn't always work, but sometimes it does and can save you some money here or there. I've done this a few times where it saves me, 2-3% of a loss. It's a little bit more advanced, but the key is to get out. What you never want to be doing is holding this thing 5 weeks later as it continues lower and lower and lower and lower and lower and lower and lower. So if you want to get a little fancy like me, you could go to your broker and you could put it in for 9:35 if there's going to be a gap down. That gets you out a little bit outside of the open, but the key is to get out. I'd rather you get out at 9:30 than to hold the thing for weeks and weeks as it declines. So I do these little advanced things. You don't have to do it, but I figured I'd mention it. And this is Interactive Brokers. I just figured I'd mention. You go there and you go to the calendar. This is under the classic Trader workstation here, and then you put the time. So I would put in 9:35 here. If I knew a stock was going to gap down, let's say I had owned Netflix here and I had planned to get out at $1,000 loss, and all of a sudden I see Netflix, I'm going to have a $1,200 loss. What I would do is I'd put it in as a market order to sell it at, let's say, 9:35. So I don't get too fancy. I just wait a little 5 minutes, and that would get me out. Maybe it'd save me $100, $200. It doesn't always work, but sometimes it does. So I wanted to mention that in the course in case you use Trader Workstation with Interactive Brokers. If you don't use Interactive Brokers, you could talk to your broker and they may have something similar. I'm sure they do have similar orders like this.